Hello guys, good day. Welcome to another video lecture in ACC 311 Income Taxation. In this video lecture, we will be discussing about the procedures on the computation of the taxable income and tax due for income derived by an estate and a trust. Okay? When we talk about estate, it refers to the mass of all property, rights, and obligations of a person which are not extinguished by his death. Okay? So what is being taxed here, guys? I'd like to um, make it clear that what is taxed in this income taxation topic is the income of the estate, not necessarily the transfer of estate from a decedent to its beneficiaries or to its heirs. But what is being taxed here is the income derived by the estate prior to the distribution of that particular estate to the heirs, because the taxation of the transfer of that estate to its beneficiaries will be considered in your transfer taxes. But again, our focus here is the computation of the income tax due of the income of the estate itself. On the other hand, when we talk about trust, it is the right on a property, real or personal, held by one party for the benefit of another. So again, just like your estate, what is also being taxed here is the income of trust when it is in the hands or it when it is in the custody of the fiduciary before it is being distributed or before it is being transferred to the beneficiary of the trust. Okay? Now, when does an estate and a trust becomes a taxpayer? An estate becomes a taxpayer when it is under settlement or administration. So as what I have mentioned earlier, your estate becomes a taxpayer when an individual, or shall I say a decedent taxpayer or a deceased taxpayer, is having an estate, and then such estate is earning an income, because obviously when a taxpayer dies, its estate may continue to earn an income, and still that income earned by its estate will be subject to tax. On the other hand, trust would become a taxpayer if, under the terms of the trust, the fiduciary must accumulate the income. When we talk about fiduciary, guys, it is a person again who Again, when we talk about a fiduciary, it is an individual who takes the custody of the property being entrusted by the trustor to the beneficiary. Or in short, fiduciary stands as the trustee of the trustor. Okay? So, before the property will be distributed to the beneficiary due to inability of that beneficiary to take that property, maybe due to the reason of minority of an individual, or in short an individual is still minor, so that means that individual cannot have that property yet. So therefore, there is that fiduciary who will take the temporary custody of the property that is being entrusted of the trustor. Okay, when that fiduciary accumulates income over from that trust, then that means such trust would be considered as a taxpayer. A trust is also a taxpayer if, under the terms of the trust, the fiduciary may accumulate or distribute the income or in his discretion. Okay, in short, guys, there is an income tax derived by an estate or a trust when these two, estate and trust, earns an income. Okay, continues to earn an income. When is the income of the trust taxable to the grantor? Okay? If under the term of the trust, the title to any part of the corpse or principal of the trust may be revested or reverted to the grantor, the income of the corpse or principal shall be taxable to the grantor. And if under the term of the trust, the income of the trust shall be applied for the benefit of the grantor, the income that shall be applied for the benefit of the grantor shall be subject or shall be taxable to the grantor. Treatment of income distribution of the year's income to heir or beneficiary. Okay? What will be our treatment if ever there are portion of the net income of the estate of that or of the trust is being distributed to its beneficiary. Okay? When an estate or trust is a taxpayer, a distribution of the year's income to an heir or beneficiary is considered as a special item of the deduction for the estate and trust and a special item of income to the heir or beneficiary. So that means, guys, any distribution of income from the income of the estate or trust will be considered as a deduction in computing for the taxable income of the estate or trust, and on the other hand, it is taxable income. It will be added as other income on the point of view of the heir or of the beneficiary the moment they have received their share in the net income of this estate or trust. Okay? Now, how are we going to tax an income of estate and trust? Take note that when there is an income from an estate or trust, it will be taxed as if it is an individual taxpayer. So therefore, the format of computation for the taxable income and tax due of an individual taxpayer is also applied in the computation of the taxable income and tax due of the net income of your estate or trust. So we have here, for example, gross income, less deductions. So the allowed deductions for an estate or trust's income only comes into two ways. First is the allowed business expenses, and second, the distribution of the year's income to the heir or beneficiary. So again, guys, simply to compute for the taxable net income of an estate or trust, you just simply deduct your business expenses and any distribution made to the heir or to the beneficiary to compute for the taxable net income. And again, to compute for the tax due, since again, based on our um, discussion earlier, that the computation of your tax due, guys, for estate and trust will be computed as if it is an individual. So therefore, we will also use the tax table to compute for the tax due of the estate of the trust. Okay, I'd like to emphasize, guys, that in the old tax code or in the NIRC 1997, there is an additional exemption of 20,000 that is given as a deduction to compute for the taxable net income of the estate or of the trust. But however, that 20,000 exemption was amended by train law. Therefore, starting January 1 of 2018, your 20,000 basic exemption is no longer applicable in computing for the taxable net income. So that means deductions that can only be deducted or that can be availed by the administrator of this trust or this estate is only your business expenses and your distribution to heirs or beneficiary to compute for the taxable net income. Okay, so there are times that there are several trusts within a common grantor and a common beneficiary. Okay? So, what is the rule to be followed when there are several trusts in a common grantor, with a common grantor and a common beneficiary. So when in terms of filing of separate returns, a separate return will have to be filed for each trust by the respective trustee or fiduciary. So for example, there is one grantor or one trustor pero different trustee or different fiduciary pero common beneficiary. For example, the grantor is A, okay? The grantor is A. Pero ang iyang beneficiary is si B, okay? There are a lot of, for example, there are three trust that is being entrusted. For example, Trust 1, ang grantor is still si A, pero ang iyahang trustee is si, let's say, si X. Okay? Another trust number 2, ang iyahang trustee is si Y. Third trust, ang trustee niya is si Z. Pero, isa lang ang grantor, isa lang din ang beneficiary. Or, isa lang ang trustor, isa lang din ang beneficiary. Si grantor or trustor is si A, si beneficiary is si B. Pero, there are three trusts entrusted to three trustees or fiduciary. So when that happen, guys, when there are multiple trusts with a common grantor, with a common beneficiary, there should be a separate return that will be filed for each trust by the respective trustee or fiduciary. However, in terms of the computation of income tax for that particular trusts, an income tax shall be computed on the consolidated income. So that means in computing for the taxable income of that trust from a common grantor, all of the income from those three trusts or from those multiple trusts will be combined to compute for the taxable income. Okay? Apportionment of the consolidated income tax to the different trusts after computing the total tax due of the combined taxable income from the different trusts, you simply apportion the total income tax due to the different trusts using this formula. For example, we have here taxable income of trust 1 over total taxable income of all trust times consolidated income tax to compute for the income tax due to be shared or to be paid by trust 1. Okay? So, in short, the formula will be, for example, for trust 1, so in our illustration earlier, we assume that there are three trusts. So, taxable income of trust 1 over taxable income of all of all the three trusts times the consolidated income tax, which has been computed with the combined taxable income of the three trusts. Okay? And then, the tax payable of each trust or each trust shall pay an income tax still due as follows. Income tax apportioned to the trust minus income tax already paid by the fiduciary of the trust if ever there's any, if ever nga there's already amount paid of tax per fiduciary or per trustee, such will be deducted to compute for the total income tax still due. But of course, if um, each trust, each fiduciary of the trust hasn't paid anything as a form of income tax due, then that means automatic whatever is the income tax apportion to every trust will be equal to its income tax still due. Okay? So later on, we will use these concepts into illustrations. Okay? As mentioned earlier, income tax of estate and trust will be computed as if it is an individual. So therefore, the same tax table will be used in computing for the tax due that we have used, no, in computing for the tax due of an individual. So it's the same tax table, section 24A. It's the revised section 24A per RA 10963. So again, same rule. You just simply compute your taxable income and refer that taxable income on this um, range of income with its respective tax rates and tax due. Okay, we have here illustrations. First illustration, the estate of Mr. Indiano has 800,000 gross income before expenses of 200,000. Okay, the estate administrator distributed 300,000 to the heirs in accordance with the will of Mr. Indiano. So, upon the computation of our taxable income, again, we simply deduct these allowable expenses of 200,000 and this 300,000 which is distributed to the heirs of Mr. Indiano. So therefore, we have a total deductions of 500,000 being deducted to our gross income of 800. That gives us a total taxable income of 300,000. So again, guys, the computation of the taxable income for an estate or for a trust is somehow simple compared with the other computation of taxable income, because in this case, we will only be considering two types of deductions to compute for the taxable income of an estate or trust. So again, we simply deduct business expenses of 200 and distribution to the heirs worth 300,000 to our total gross income of 800,000. So that means our taxable income is 300,000. So again, using the tax table, guys, it belongs to the range of 250 to 400,000. So that means for the first 250,000, its tax due will be zero. In excess of 250,000, its tax rate will be 20%. So therefore, we'll have 50,000 times 20%. So the total tax due is 10,000. Okay? So it's how simple the computation of the tax due for an estate or a trust. Okay, but I'd like to put an emphasis on how are we going to compute gross income, guys. Gross income, again, just like how we computed gross income in our previous discussions. Gross income, from this is from your gross sales minus any sales adjustments less your cost of goods sold plus your other income, other operating and non-operating income. So that will be included in the computation of your gross income. Okay? So in this case, the administrator of Mr. Indiano or the administrator of the estate of Mr. Indiano will pay 10,000 as income tax due of the estate. Okay. Next illustration, we have here Kevin designated an irrevocable trust to a property in favor of J and appointed KJ as trustee. So we have here three parties, the grantor, the beneficiary, and the fiduciary. So we have here Kevin as our grantor or the trustor. We have J, the beneficiary, and we have KJ as trustee or the fiduciary. Okay? Take note what is being designated is irrevocable. I'd like to put an emphasis also in this, guys, that only irrevocable trusts are taxable. Okay? When the trust is considered as revocable, that means the trustee or the trustor or the grantor can still take that trust back when it is revocable. That means when it is revocable, it is not subject to tax. Okay? It will not be taxable if the trust designated is revocable. I'd like you to take note of that. Continuing the illustration, the property earned 1.5 million income before expenses of 200,000 and trust fees of 50,000. Okay? Trust fees meaning it is an expense related to the trust. In accordance with the trust indenture, KJ distributed 100,000 to J. So that means we have a total deduction of 200,000 as our expenses plus 50,000 and 100,000, giving us a total allowable deductions of 350,000 to be deducted to our total gross income of 1.5 million, thus giving us a total taxable income of 1,150,000. So using the tax table, it belongs to 800,000 to 2 million range. So that means for the first 800,000, it will be subjected to 130,000 tax due, and excess of 800, that will be subject to 30% tax rate. So that means we have 350,000 times 30%. So we have additional tax due of 105, giving us a total of 135,000 tax due. Okay? Who will pay for this 105, 235,000? Who will pay for this tax due of 235,000? The ones who will pay this 235,000 is the trustee. Okay? It's the trustee or the fiduciary who will pay this income tax due to the BIR using, of course, the amount or the money from the income of the trust. Okay. Another illustration, guys. What if there are multiple trusts from a common grantor or common trustor with a common beneficiary? Okay. For example, Don Jose designated three trusts, all in favor to his son Joe. So there were three trusts that is being designated. Two were irrevocable and one is revocable. So obviously, guys, as what we have mentioned earlier, we have only irrevocable trust are subject to tax. So that means we need to disregard trust 3 since trust 3 is revocable. Okay? So it's AJ and AJ and BJ who were the trustees of trust 1 and 2 respectively. Now, for the purposes of taxation, guys, for the purposes of computing the taxable income of the trust, of this specific trust, needless to say, we need to combine all the taxable income of Trust 1 and Trust 2 to compute for the combined taxable income, which will be our basis in computing for the total tax due of the trust. Okay? So in this case, we have here combined operating income of 700,000 or combined gross income of 700,000. So that's from Trust 1 and Trust 2 of 300 and 400,000 respectively, less allowable deductions distributed to the years, which is 30 and 40,000 respectively. Okay? As where did we get that 30,000 and 40,000? Let's go back with our illustration earlier. So we have distributions of 30 to 40,000. Okay? So that means that will be considered as a deduction. So we have here 70,000 total deductions allowed to be deducted to our operating income of 700,000. So we have a taxable income of 630,000. So using the tax table, again, we compute the tax due. It belongs to um it belongs to where did it belongs? 630, it belongs to 400,000 to 800,000. Okay. For the first 400,000, it is subject to 30,000 and exists. We have 230 times 25%, so we have 57,500. So we have a total tax due of 87,500. So again, what's the rule? 87,500 will be the total amount that will be paid as tax due. But take note, these 87,500 will be shared by both Trust 1 and Trust 2. Okay? So in short, EJ and BJ will be contributing an amount to satisfy this 87,500 tax due. But the question is, how are we going to compute? Huh? How are we going to compute for how are we going to compute for the share? So we simply compute by having 270,000 divide 630, which is the total taxable income. So we have 270 coming from 300 minus 30. So we have 270 divide 630. Then multiply it by your total tax due of 87,500. So that means Trust 1 will be sharing 37,500 of this total 87,500. And Trust 2 will also be sharing 50,000 out of that 87,500. Okay? So again, as mentioned earlier, we have Trust 3, which is not considered as which is considered as not taxable since it is revocable. The entire 500,000 of Trust 3, including the 50,000 income distribution, will be included in the taxable income of Don Jose. Okay? So, it is not subject to tax on the point of view of the trust, but your Trust 3, since it is revocable, it will be taxed on the okay, it will be considered as taxable income on the point of view or on the income tax return of Don Jose. Okay? Sige. So that's the procedures that we need to consider when there is actually multiple income from common grantor to a common beneficiary. Okay? Before we end with our lecture for this short topic in taxation for estate and trust, let us consider first important notes in terms of filing the returns and payment of tax. So, who shall file the return? Okay, who shall file the return? The following persons acting in any fiduciary capacity shall file the income tax return for an estate or trust. Okay, so it's either the guardian, the trustees, the executors, administrators, receivers, conservators, and all other persons or corporations acting as fiduciary. Whoever acts as fiduciary for the estate or the trust guys will be the one pay, who will file the income tax return and at the same time will pay the income tax due. Obviously, guys, the income tax due will be coming from the income of the estate and the trust, not on the personal pocket of whoever is the fiduciary. And then gross income, if the gross income is 50,000 or more, the return shall be filed if the estate or trust has a gross income of 50,000 or more during the taxable year. And then, when there are two or more fiduciaries, as mentioned earlier, in case of two or more joint fiduciaries, return filed by one of them shall be sufficient compliance with the requirements of the tax code. So it's either one of the two fiduciaries or it's either one or two na mga fiduciaries, joint fiduciaries is already or will suffice the compliance requirements of the tax code. It's not necessary that, for example, you have three fiduciaries, si three fiduciaries po ang mag-file ng income tax return. It's either or it's one of them. Okay? Any of them can file. At least merong isang fiduciary na mag-file on behalf of the entire trust. Okay? So those are the necessary important notes that we need to again remember in preparing for the income tax return for estate and trusts. Again, that's the end of our video lecture in computing for the taxable income for an estate or a trust. If you have any more clarifications or questions regarding the topic, you may reserve that and ask during our video or not video lecture, but virtual class during our virtual class, or you can comment down it below for us to immediately answer that question. So again, that's it for our video lecture. Thank you very much for watching and see you on our next video lecture in taxation. See you and God bless. Thank you very much.